Hello everyone, welcome back to another quick video I've got here today. My name is Mayur. I am an analyst and co-portfolio manager here at Zacks Investment Research. And I'm just going to continue with the same theme and discussion that we've been talking about for the last several weeks and months. And I'm actually going to use literally the same exact header slide that I showed last time. And I've been kind of saying this for many months now, that in my view, inflation has likely peaked, but the question is why. Today is Thursday, January 12th, and we just got, the market moving news of the latest read on the CPI. I'm just pulling up their website right now at bls.gov. You can see a little bit more about, just a visual representation of what the number came in at 6.5%. That's well off the highs that we saw of 9.1%. If I change this to look at a more historical measurement, you can see that the rate of inflation has now clearly slowed well off the highs that we saw in the summer of last year at 9.1% and heading down now. It's still up year over year, which is not what we want to see, especially given the fact that we've had this massive run up in inflation, the greatest we've ever seen in 40 plus years. So just to get back to mean reversion, back to say 2019 levels would require a substantial drop further below zero for quite a while, just for us to reset prices back to where they were in 2019. But you can see that the trend has begun, and I've been, talking about why this is happening. If I were to open up ZRS and if I, show the sort of relationship, between the ISM backlog index and the CPI, you can see a very clear relationship between the two here. So here's the backlog index as we see, that peaked in the summer of 2021, and it's been heading down ever since. It's now actually below 50, which means that it's now finally in contraction year over year. And backlog leads the CPI. You can see that it starts to make major turns ahead of the CPI, most times in the past. And this time was really no different. So we saw that, backlog started to move quite substantially off those highs. And then, now we're finally seeing the effects of that, finally in the prices that consumers pay. And that's now starting to roll over. I actually expect that this number, we might actually see a below zero CPI. I've been talking about inflation heading down, all this time. Now my next prediction is that I think by summertime this year, we may start to see the CPI show negative year over year, percentage growth. So that's quite a ways to go, down. But I think that's what's going to happen, especially if the backlog continues to remain in contraction, which it is right now. So that's my new prediction, is that we will see a negative, year over year print on CPI. Right now, that's not being forecast by economists, but I believe that that's what's going to happen. One of the reasons why I think that's going to happen is because of recession. And here I just brought up our advisor tools, platform, and I'm just charting the spread between the 10-year Treasury yield and the 2-year Treasury yield. And this is one of my favorite leading indicators for a recession, and you can see it's had an impeccable track record. It flips negative. It inverts, just before the onset of a recession. So it did it proper. It actually did it just almost right before the COVID recession. Didn't quite get there, but, it was in the process of getting there. But it, very clearly forecasted the 2008 recession, with absolute clarity. It forecasted the 2001 recession with total clarity. And it also forecasted the 1991 recession with total clarity. So this has a very, very, substantial track record at getting ahead of recessions. And we're once again very deeply inverted, the most we've been in 40 plus years, taking us all the way back, to the late 1970s, early 80s. So I believe this time is going to be no different. I believe that this will be a recession just like those prior ones. May not be as bad as 2008, but I could certainly see it being as bad as 2001. In fact, I currently believe that that's going to be the closest comparison as far as what this current recession will look like relative to other recessions in the past. I think it's going to be very similar to 2001, where we do see an uptick in unemployment, but not as bad as what we saw in 2008, where we saw banks on their knees essentially. So this is a very very telling indicator. I believe that this is very clearly forecasting recession, and in recession demand gets destroyed, and that's very, very bearish for prices. So that's why I believe that the CPI will actually see a negative year-over-year print. And that wouldn't be out of the realm of possibilities, especially if you consider the CPI just simply reverting back to mean. This doesn't require, a draconian recession. All it means is that if we were to just revert back to mean level prices, we would need to see the CPI, stay below zero for some time. And that would just simply take us back to 2019 prices. So it's not something, it's not as draconian as it sounds. But, I believe that even a garden variety recession will take us there. And another reason why I think that this is going to happen is if we look at the Chicago PMI, I've been, talking about this quite often as well in my past webinars. This has been in contraction for several months now. And I believe that that's going to stay that way for some time. You can see if you look underneath the hood, the Chicago PMI prices paid index has been in decline for the past year, really over the past 12 months. It has been in a straight line downward. You can see that there. So this is the prices that manufacturers pay. So before consumers start to see price savings, we need to see manufacturers experience, deflation. And this is a leading indicator for CPI. So, now that we are seeing prices paid, in contraction for the past year, I believe that this is going to now translate into further losses for the CPI. We can see multiple other subcomponents of the Chicago PMI are in contraction as well. The overall index is also in contraction. It did bounce back, though. In the latest December reading, it bounced back to 45. That's a 7-point swing, 7.7 point swing, which is quite a big swing, but it's still below 50, which means that we're still in contraction. So the longer it remains under 50, the greater the chances we're falling into recession. But here's the other thing too, is as investors, we have to ask ourselves, is the market pricing this in? So if I were to look at the Chicago PMI, and this is a chart that I've showed in the past as well, but the Chicago PMI shares a very, very interesting correlation with S&P earnings growth. And you can see that as the Chicago PMI moves, so do the earnings for the S&P 500. And you can see that now that Chicago PMI has essentially flatlined and we're now well below 50, which is contraction. I would not be surprised at all to see the S&P post a yearly decline. I don't expect it to be a massive decline, but I think it could be easily within the range of, somewhere between, 2.6% to 13.3%, somewhere in that range. I know that's a pretty wide band, but considering that even if you were to expect a 2.6% drop in earnings year over year, the market's trading at, almost 17 to 18 times earnings. So that's not a recession PE by any stretch. So if you were to, actually model a 3% decline in earnings and put a recession multiple on that, that still represents pretty substantial downside to the market. And my exact sort of expectation is roughly $210 of earnings and a 15 multiple, which gets us to about 3150 on the S&P. We just touched 4,000 on the S&P as of today. So I believe that that a recession in either the economy or earnings is not being priced in right now in the market at all. So although recession is being talked about quite often out there in the financial press, I don't think that's priced in right now in the market. Could be wrong about that, but I have a pretty high conviction that we will see further downside in the market before we start to see a new secular bull market emerge. And the Chicago PMI is really telling me that earnings are going to be down year over year. So it really depends on how down they are, right? If it's just a 3% decline, maybe the market doesn't go all the way down to 3150, but I still think it does go down from here. If it's a 13% drop, then yes, I think it's a pretty large, decline from where we are today. So these are the key sort of indicators that I'm watching. I think it's very, very important to pay attention to them. The other, indicators that I'm also seeing that are kind of confirming what the yield curve and what the Chicago PMI are telling us is increasing initial claims. Now, this is off of a very low base, so it may not be, it's kind of misleading here. But, you can see that initial claims have started to move up on a year-over-year basis. So the percentage growth year over year in initial unemployment claims are up, well off the lows. If this trend sort of builds, that's, again, another coincident sort of confirmation that we are entering recession. At the same time, you can see that new orders are now declining. We're now at the lowest level in years, really, since, the COVID drop. So is this another sort of indictment? Not yet, but you can see that the trend is down. We were actually stabilizing quite nicely right around this 2% mark, but we just broke below it, as of December. And now we're basically flat year over year. So I think the trend is down. I think we'll see negative growth in, the new orders for durable goods index. Same thing with factory orders. We used to have this, this was a number that was very healthy, but now it's, in decline. The rate of change has slowed quite dramatically. It's still growing year over year, but you can see that the trend is clearly down. So based on what I'm seeing from, the yield curve inversion, based on what I'm seeing from Chicago PMI, and the anecdotes that are embedded in it, based on, a number of subcomponents of both the Chicago PMI and the ISM Manufacturing Index, as well as these two indicators here, I'm seeing too many leading indicators and coincident indicators starting to show significant deceleration. So that kind of confirms what the Treasury yield curve has been telling us, for some time now. And that is that I believe that there is an oncoming recession, which will hit S&P earnings. And as a result of this, by the way, analysts are not just sitting on their hands. If you look at the S&P 500, we have seen substantial estimate revisions down. And I believe this is just getting started, because as of right now, analysts are still expecting growth year over year, but the rate of change has slowed significantly. You can see that right here. We hit a high watermark in, the late spring, early summer, and it's been nothing but earnings estimate revisions downward, ever since. And this is for 2022. It's much worse for 2023. You can see here. We hit, a high mark of about $6.49. That's a bottom-up reconstruction of the S&P. That's been revised down to about $5.84. You can actually look at it on the aggregate numbers. If I, put in SPX in here. For the XPX, we're, now at 210. So this has been a substantial revision down, in 2023 expectations. So again, I don't believe that the market is pricing in recession. If you look at, the current multiple on the S&P 500, it's, nowhere close to being where we traditionally are, even during garden variety recessions. If I were to go back and look at, the max history here, we're at almost a 19 multiple on a forward basis for PE on the S&P. That's 18.7 times. That's quite a ways away from where we were in 2008, and where we were in the in the recession after 2001. You can see that it got down to 16 to 15. I believe that's where we're headed right now in this current recession. So, if we were to, use a 15 multiple on $210 of earnings, again, that's a pretty substantial downside. We're at, we're at 39.73 as of today on the S&P 500. So that's, more than a 20% drop, I believe. That sounds like a lot, and it really is, but that's just forecasting a garden variety recession. I know I hate to be a significant bear. I'm long-term bullish. I love the long-term compounding mechanism of the market, but I am short-term very cautionary because of these fundamental indicators of the economy that I'm seeing here. So that's all I had for today. CPI down, and I believe that's going to continue down. I believe that's going to actually invert negative at some point in 2023. But while that sounds good, it's for bearish reasons, which is demand destruction, as we see from several economic production gauges like the Chicago PMI and factory orders and others like that. So we will see. I will keep in touch very much so, and hold myself accountable. I'd love to make sure that whatever I say on these webinars, we do revisit them to see whether I was right or wrong, and we can all kind of learn together as we go. So if you have any questions, please do reach out to me. I'd love to hear any feedback and comments, suggestions. You can reach us if you are a ZRS client, please reach us at zrs@zacks.com. Or if you are an advisor tools client, please reach us at zat@zacks.com. All right, thanks everyone, and talk to you soon, and hope to see you soon. Take care. Bye-bye.